welcome to the closing bell on the 26th of March. Look, it's been a bit of a weird week this week. I'm scratching my head. I think plenty of people are. Bonds are selling off as expected. If you did watch my closing bell last week, I was saying those US 10 years up through 2.2%. I didn't see any resistance to the yields until about 2.6%, really. And we did see a huge move this week in those bonds. So the bonds really are selling off. 2-year yields flying higher, moving from nearly zero, 0.2 of 1% 6 months ago, to 2%, over 2%. One of the fastest rises in yield that I've ever seen. And stocks have just turned and gone vertical since the Fed raised rates. So I'm wondering how long that situation can last. So I just want to show you the lay of the land in those bonds, show you how a correction develops and where the risky points are that you want to keep your eyes on, and then finish up with gold, because it is actually looking pretty good, and maybe throw in a gold stock there at the end for you. So let's check out how these bonds are moving. So just looking at the US 10-year bond yield, that's what this chart is. If you've been watching this, you know how I'm looking at this. We've got the range created in 2013-14. That's what I'm making these calculations off, all these lines you see here. And the main line, of course, is the midpoint, which is the point of control. And the yield just oscillating around that range. And we're doing it again. This is the last rise in yield since the crash in 2020. And it's really starting to gather pace now to the upside. If you've been following these videos for a while, you'll remember I said once it headed above that 1.8% region, it should be a pretty quick trip back to the point of control. And that's now happened. But if that point of control doesn't prove to be resistance, or often it will rotate all the way through there to the other side of the range, is what you can see. So the way I'm seeing it here with this sell-off in bonds, and that's actually a sell-off in bonds with the yields rising because the price falls as the yield rises. Where is this going to stop? And with stocks still rallying, even though the bonds are selling off, at what point will stocks sit up and take notice of these bonds? So that's what I really want to focus on today. The major level where you've really got to worry is above that high from 2019, but that's up around 3.2%. I can't see the 10 years selling off there anytime soon, but tell you what, if they do, stocks will not be ignoring the sell-off in bonds if we see another 1% rise in those US 10-year bonds. But what I could see happening, and this is what I was discussing last week, was that there's no real reason for those yields to stop rising until they reach the sell zone of the most recent wave down. So what we're looking at there is that long-term downtrend in yields, and the way these prices move is that you often get a lot of resistance in that sell zone of the most recent wave down. So when you're selling off, you've got the big reactions. That's probably got to the midpoint before selling off. And, so often, if we even just look at this wave down here, you'll see that prices went, the yield went up into the sell zone of that wave there, and that's where things then turn down for that next leg, the next rally in bonds and the fall in yields. So that's just a really important zone where if that long-term downtrend is going to continue in yields, that's where it should hold up. So that's that 2.6 to 2.9% region. And we're not that far off there. So it could be a matter of weeks. And what I'm interested in is, if this selling accelerates in these bonds, when do stocks actually say, wow, we'd better think about this? Should we be rallying, or is it time to hit the sell button? So that's why I just wanted to point that out, that there is just no reason for these yields to slow down their rise until they head up. And really, you need to see some sort of a U-turn before you could say, it's maybe reached a high. So, where are they going to stop? And who knows? I mean, it could even accelerate. And if it goes through there, especially up through there, is like, wow, that's where there could be some panic evolving. And I really don't see yields getting that high anytime soon. But that really is the thing that we need to watch as these markets are bullish in the short term. So I just wanted to show you the move higher and just point out the area where we just have to be a little wary. So with this correction that we've seen from the high, the way I look at it, and again, it's how these downtrends evolve, is that you have, big wave down, gets everyone short, you get these big short squeezes, and they often go up into the sell zone of that area, which is what squeezes all the shorts out, gets everyone bullish again. Look, everything's looking great. And then that's where the selling comes back in. So that's where you have to look for reversals, because if we are going to start a downtrend, that's how they take shape. So it's, watching how prices behave up in that area. And that's sort of that 46.30 to 47.20 in that E-mini S&P 500. So, things looking good right now. And really, I could also make a case just to give you a really full appreciation of where all the levels are for those that are interested. Because if we look at how this is currently evolving, you'll see that we do have this little downtrend developing. And where we are right now is just up in the sell zone of that most recent wave to the downside. So this actually, where prices are now, is an area where the selling can come back in. And the weekly trend is still down. So I wouldn't get massively bullish just yet. That's all I'm saying, I guess. And there's two levels around where we are now. And then if it can actually break through up to that 46.30, 47.20 region, if it turns down from there, I'm going to be a little wary. And especially if those bonds are really selling off at the time. Moving on to gold, and look, it's really holding up very well in the face of rates flying higher, because the Fed is hawkish and they've really changed their tune. They're saying they are going to go after inflation. They're going to raise rates quite a lot, and even 50 basis points at a time. That's why everyone's sort of going, wow, this is a changing situation. And usually you'd think gold might actually come under selling pressure if people think rates really are going to ratchet higher rapidly. But they're not. Gold has been bought. I think we need to keep an eye on it, because it could turn down on the basis of what's going on in rates. So it is something to be aware of. But the way it's trading is very strong. If we just look at the trend that we've had going, again, you should know this whole setup that I've got for you. The correction from that all-time high is the major thing to look at. And we've got the buy zones. I've gone through this many times. That's where you want to see the buying pressure. We've seen that. Lots of resistance around the midpoint, that point of control. Struggling to get up there once, but it's basically traded below there for ages. And now we're up in the top section of that range. And we really want it to hold up there, as I was saying last week, and it is doing so, which is heartening, because if you look at the weekly trend here, the 10-week Exponential is there. And it has actually been in a weekly trend for quite a while, a weekly uptrend. And it's good to see after the really strong selling pressure from the all-time high that it's hit that 10-week exponential and is holding up. But the one bearish thing that I want to point out is that we did get a weekly sell pivot last week. And how markets behave is that they have the initial momentum shift to the downside, but then you see buying pressure after that initial turn. And then if the selling pressure comes in, then that's when it can go pear-shaped. So what I'm saying there is we can have a wave higher. We get the sell pivot, which is quite strong, but the buying pressure comes in, which means you rally back to the upside. But if it turns back down again and breaks through those lows with that sell pivot active, it can look bad pretty quick, especially back under that 1880 region. So I just want you to be aware of that. And with rates flying higher, everything is on the table at the moment with these markets. You've got to be aware of that. But where things stand, quite impressed with how gold is holding up. And we all know that if it breaks out above that all-time high, it is blue sky above there. So really, my view on gold is probably lots of work done in this area, in the top section of that range, before having the strength to really power off. And there are a few stocks out there that are interesting. Regis and SBM, as I've discussed with you in the past, on the edge of a monthly buy pivot this month. And often once you get that monthly buy pivot, that can be the start of a bit of a move to the upside. So there are a few gold stocks out there still beaten up that could be in for a bit of a run. Those two are the ones to, I think, just have a look at. But apart from that, really, I'm just waiting to see whether these stocks can continue levitating despite the fact bonds are getting smashed. I doubt they can get that much higher if the bonds keep going down. All right, that's it for this week. Check out what I'm up to below the video there, my Australian small cap investigator and pivot trader, and a new one I've just started up, microcap trader. So I will stop speaking now and let you get on with your day and come back with more next week. Cheers.